Hello and welcome. This presentation is titled How a Losing Trader Thinks. I'm your host, Jason Allen Jankowski, the Lion of LaSalle Street. Thank you for coming. I think you might be surprised where I take some of these insights today. So I would encourage you to keep an open mind and remember that our goal as a trader is to pull consistent money out of the market. But the fact is, most of us are not doing that. And there's a reason why that is. It may be a very simple reason, could be a complicated reason. But for the most part, most people are consistently losing because they're thinking in a manner that is not consistent with how the market actually functions. And we'll have plenty of time in other broadcasts to discuss some of these important details. But first, let's get started with how a losing trader thinks. First off, trading in off-exchange foreign currency, or Forex, is considered a risk investment. It's not suitable for all investors or traders at all points in time. So you want to make sure that you're emotionally and financially capable of assuming these risks. And everything we talk about in here is considered opinion. It's subject to change at any time. So let's get started. First of all, I want to take a minute. This is the first of the lessons in this 5-part series of Bedrock Fundamentals. And so I think it's important for you to understand a little bit about me as your host. I've been trading about 30 years now. I started in 1986 as a customer, just like most listeners. And I did everything that most listeners have ever done when it comes to market education, training, and research. I did the exact same thing that every one of you listening has done. However, when I started in 1986, by the way, I did my very first trade in Chicago Board of Trade big board corn, and boy, was I hooked. I absolutely loved it. And I knew this is what I wanted to do for my career. So you can imagine there's a difference between saying I'm going to make a career out of something and maybe just opening an account and trying to make a little bit of money. I knew this is what I wanted to do, and I figured this is going to be it, man. I'll be retired early with more money than I know what to do with. I was absolutely hooked, and up to that point in my life, I had been a success at almost anything I had attempted to do. And for those of you that may have read some of my books, I talk about my early years in The Art of the Trade, which was published by Wiley & Sons, 2008, and talked a little bit about my early years. And the bottom line is that I came into this business thinking that this would be no different than anything else I had ever done. I had learned how to make myself successful at almost anything I had tried, had a lot of great opportunities as a young man, and I think, why would this be any different? So I did the exact same thing that everybody did. I went and read the books, took the courses and the video series, and attended the weekend retreats and the seminars and all that fun stuff. And I want you to remember that in 1986, when I started in this business, there was no internet, there was no email, there was no free webinars, there was no online service, support, training, education, etc. What you get right now for free over the web dwarfs what I had to pay money for if I wanted to learn something. And I literally spent all kinds of cash. I actually quit counting at around $60,000. I probably spent more than 100 grand on a lot of the same stuff that you've done. Books, tapes, audio series, educational seminars, retreats, coaching, everything and anything you can think of. And I got my ass kicked for years. I lost money on balance for years. In 1987, I got into the business as a full-time Series 3 registered commodity broker. And that story is also explained in The Art of the Trade. And I learned some very heartbreaking things about what it's like to be in the business of trading and why winners win and losers lose. But for me, I bought into this whole concept, maybe like you have, that this is all an issue of study and research and analysis, and then eventually I could figure out how to make money. And I lost money on balance for years. One day, the light went on for me. and my life changed dramatically. It's an epiphany type of experience, catharsis in my thinking. And not everybody goes through that, but for me, when I went through it, it changed my life. And I never looked back. Today, I'm a net winning trader. Yes, I have losing days. Yes, I have losing weeks, occasionally a losing month, occasionally a losing quarter. But year after year after year, I pull net profits out of the market. Now, what's the difference between a winning trader and a losing trader? Well, one of the things we're going to talk about today is how a losing trader thinks. And you may be surprised at where I take these insights, and you may see yourself as one of those losing traders that thinks according to the information I'm going to give you. And I don't want you to feel that that's a problem, because it's really not. I had the same thinking. But when I really came to an understanding of what it was that was different between winners and losers, I was able to finally exploit the opportunity that the market provides us every day. And the reason I told you that is because the information that you're going to see today and in every other part of this series or any other material that I provide you, this comes from inside the marketplace from an insider's point of view and an insider's edge. It's different than what you see elsewhere, and you may be surprised at how that difference becomes known to you. What I want you to do today is take this at face value, think it through, and let's see if this can really provide you some really solid benefits. So first of all, let's take a quick look at this material. First of all, what is it about trading that becomes so difficult for so many traders? A lot has been written on the psychology of poor performance, and I think that in the business of trading, the issue is really no different. Every trader must learn to trade, and this process is not unique. To succeed at anything, you must learn and understand what needs to be done for success in any particular endeavor. You want to be a heart surgeon? You got to study the things that are important for heart surgeons to know. So if someone, meaning anyone, if they've succeeded at something, that means it can be done by anyone else as well. Now, what is the essential difference between those who lose and those who win in that environment? See, I'm of the opinion anyone can learn to trade. It is a learnable skill. If an individual is willing to take the steps needed to join the ranks of those who win, I think anyone can learn to do it. Now, not everybody agrees with that point of view, but I feel that way. Because if anyone needed help to try to figure this out, anyone had a back end to this that was just never going to work, it would have been me. And rather than go into those details, let's talk about this. What causes someone to lose? Really, ask yourself, what causes someone to lose? It doesn't matter who you are, me, you, anyone. What causes someone to lose? What's the essential difference between those who win and those who lose? I'll tell you why you need to know what causes someone to lose. Because without that knowledge, you cannot learn what to avoid in your goal to succeed. How are you going to learn to win if you don't learn what not to do at the same time? All losers, this is people who failed at something they believe they could succeed at. They share common traits and common behaviors. So if we look at people who failed at something and something that they felt they could succeed at, there's similarities between all of them that I feel can be seen in the results too from losing traders. The interesting thing is that all of these failing tendencies have solid tools that can be applied to reduce or eliminate degrees of failure and even turn a failure into success. But most people are not willing to learn those tools, and they're not willing to adapt to those changes. The similarities are common to every person as well. In other words, everything you or I experience when we attempt to succeed at something is the same as anyone else's experience. There's nothing new at the core. For example, if I'm walking through downtown Chicago and a tiger comes around the corner, I'm going to feel fear. Now, you might absolutely scream at the top of your lungs and fake dead from a heart attack. Somebody else might just freeze and not know what to do. I might turn and run. Somebody else might stand there, pull off their belt buckle, and figure out they're going to try to figure out how to kill this damn tiger before they're shredded. It doesn't matter what the response is. The fact is, every one of us feels the same thing. We feel a sense of fear, right? So there's nothing new at the core. So no matter what you and I wish to succeed at, we're all going to share the same experience and the same issues to get there. If I'm trying to make $1 million from trading, I'm going to experience the same exact things that you experience at some point on some level. That'll be the same for you and me and everybody else that trades. Anybody who's trying to figure out how to build a house is going to have the same problems with understanding how plumbing works and how electricity works and how the roof is supposed to be put on. There's nothing new at the core. At the core ability, if you want to learn how to do something, at the very basic bedrock issues, it's the same for everyone. It'll never be any different. Losers fail in the markets for the same reasons people fail at other things. Failure at anything is the same for anyone. Losers fail in the markets for the same reasons anyone else fails at anything else, market specifics aside. You know what that is? It's right here in red for you. They're either ignorant of what is causing their failure or they are unwilling to make the needed changes required, or a combination of both. That's it. That's it. If you're failing at trading, not getting where you want to be, you're either ignorant of what is causing your failure or you're unwilling to make the needed changes, or a combination of both, depending on you. Now, just to make sure we're all being fair here, I want to talk about an out-of-bounds issue. Simply put, it's this. If you don't have any legs, you can't learn to dance. It's pointless. If you're a paraplegic in a wheelchair, it's pointless to think you can go to a Fred Astaire dance class and learn how to dance like Ginger Rogers. It's not going to happen. You're out of bounds. In trading, I don't think there's an out-of-bounds issue, in my opinion. Anybody that can write a check for $500 or more can open a trading account in most places at this point. The markets are a level playing field. If you can open an account and get down to business, you have an opportunity. So I don't think there's any out-of-bounds issues. I don't want anybody sitting here saying, well, yeah, the reason I'm not succeeding at trading is I don't have all the computers, that somebody else has. Well, that's BS. And later on, you'll understand why I think that's BS. If you really want to succeed at this and you can open a trading account, you can figure this out. Now, you may not like the pathway you have to go on, but that's not the problem. The problem is you, and it's your thinking. So there are no out-of-bounds issues in trading, in my opinion. I think if you're not succeeding where you want to be, it's largely because either you're ignorant of what you really need to do, or you're unwilling to make a change, or kind of a combination of both. So, what are those similarities? The common traits losers have are expressed in the markets as certain choices and behaviors. Market losers operate with similar methods of thinking as other kinds of failure, and they express this thinking as where and when they buy or sell in the market. In other words, in my experience, losers share common traits, and these traits are expressed in the markets the same way that they're expressed in other places, choices and behaviors. Losers operate with common methods of thinking. They express this thinking as where and when they're going to buy and sell, and they don't understand something at the very core, basic, beginning level. See, traders have 100% control over the net result in their accounts. Now, you don't believe that, but you do. Losing traders feel they have little or no control. See, you're the one that decides to click the mouse. You're the one that puts himself at risk. You're the one that says all this stuff floating around in my head from all these charts and graphs and stuff, which doesn't work. We'll talk about that in another lesson. But all that stuff in your head that you've chosen to rely on means you come to a conclusion. You come to that conclusion, you click the mouse, and you decide to buy or sell. At that moment, you're at risk. If the market goes for you, you're the one that decides when to get out. If the market goes against you, you're the one that decides when to get out. So you have complete control over your account balance. All you have to do is click the mouse. Now, losing traders don't believe it's that simple. Losing traders believe they have a feeling of low control because they don't know what the market is going to do. As I teach in my Psychology of Trading course, and I teach in all the other material that I offer, is that it doesn't matter what the market does. It matters what you do. So if you decide to buy and the market goes against you, the faster you can click the mouse to get out and move on to another trade, the better for you. But what most people do is they feel they have no control. And this feeling of low control is the result of their loser thinking. It's not the cause of their behavior. The cause of their behavior is their emotion. But that low control feeling is the result of their loser thinking. Losers lose because of their thinking, which results in a desire for more control. See, it reinforces the loser thinking, making the process of trading a never-ending event of consistent losses. See, in other words, losers are losing because they think a certain way, which results in losses that they feel they have no control over. They then attempt to gain what they feel is control of those results by engaging in thinking based on the same thing that creates their losses. In other words, I got to get more control. Now, if you're honest with me, on all the education and training you've been doing up till now, you're thinking about this is going to give me some control over what's happening in the markets or over what's happening to my account. But it doesn't work that way, right? It's not working that way at all. So what are those similarities? And these are the common thinking traits that become failure. Evaluations, assumptions, misconceptions or illusions, justifications, expectations, exceptions or excuses, blame. All of these thinking processes are the common thinking processes to people who fail at anything. It's the same thing. All of the loser thinking patterns result in buy-sell choices that attempt to reduce risk, which is the market term for more control. But the fact of the matter is they're all coming from these thinking processes. And I'll show you what I mean here in a minute. The important thing is that what you need to understand about your loser thinking, if you have it right now, what you need to understand about it is it's common to everyone. Everybody who has failed at anything they've tried to do, anybody that thought they could succeed at something and has failed, this is why they fail. Evaluations, assumptions, misconceptions, illusions, justifications, expectations, excuses, blame, or exceptions. And I'm going to show you exactly what I mean right now. So if you're losing at trading and any of these thinking processes are present in your thoughts when you evaluate the market, when you make an assumption about what's going to happen, when you have misconceptions about what's going to happen, etc., right? I'll show you exactly what I mean right now. Every losing trader brings to the table this issue as some form of market study. This is what you're doing. In the markets, we have to decide where and when a market has given us an opportunity to profit. For most people, that means they have to study the market in some way in order to reach a conclusion. In the case of almost every losing trader, this evaluation process starts with some form of technical analysis. In this process, an assumption is also made that technical analysis can predict price action moving forward, and that's in and itself is an illusion, as any expert in technical analysis will tell you. Basically, here's what happens. A losing trader looks at what's happening in the market and says, I don't know what any of this means. I need to study it. And the first thing that they study is technical analysis, which is all kinds of fun stuff, right? And why do they do that? Because they want to reduce risk, which is market speak for gain more control. Losing traders tend to believe that technical analysis can help them reduce risk by analyzing price data in an attempt to predict price potential moving forward. That is the underlying bedrock reason why you guys aren't making it happen. You think that if you study all this crap that's put on some chart, all these dots and lines and ratios and curly Qs and all this happy bullshit, that somehow it's going to predict what the market's going to do next. That gives you the confidence to enter a position, because then you're reducing risk and you're getting more control. And when the trade doesn't work, now you're confused. See, there's an assumptive process going on as well. And the assumption is that market study will result in reducing risk, which means gaining more control, which that'll never happen. See, anybody who studied technical analysis will tell you There's virtually no predictive benefit. If you took every technical analysis out there and you used it exactly the way the developer of that analysis tells you to use it, you will find across all markets at all points in time, it has no more than a 52% chance of predicting price action. In other words, it's no better than flipping a coin. So if you want to start making money, why don't you just flip a coin every day and go long on the open if it's heads, and tails if it's tails, go short. Why don't you just do that? See, the assumptive process here is that market study will reduce risk. The evaluation process is where the assumption comes from. I've got to evaluate what all this means before I can take a risk in order to put my money in play. So I got to reduce the risk by doing all this study, and the assumption there is it's going to reduce my risk. I'm going to get more control, right? Losing traders tend to make assumptions about the meaning behind certain market-related events and how that can help reduce risk. For example, market news. A price reaching a certain level. The potential in a trading system after back testing, or some new method of technical analysis. It may surprise you. I see this happen a lot with losing traders, is that they're not making money, and they're using everything they've learned up till now. They've been trading for 3 years, their account balance is still down, and then they find some dusty book in some library somewhere, and they read it, and they go, oh my God, nobody is using the Delta system anymore. Why is that? And they dust it off and they read it, and because it's new to them, they think it's a new idea, or they've rediscovered an old idea. It's all bullshit. Market news doesn't matter. Price reaching a certain level doesn't matter. The potential in a trading system after backtesting doesn't matter. A new method of technical analysis doesn't matter. Assumptions are made by losing traders because they believe that certain things are facts, and that facts result in a sense of certainty, which is control, thereby resulting in reducing risk. The fact of the matter is you can't reduce the risk of trading. As we talk about in the other broadcasts, the other videos in this series, as well as other things that we can do if you're interested in educating yourself, you cannot reduce the risk of trading. There's only one risk in trading, and that risk is you will be on the wrong side of the order flow. See, we trade in a zero-sum environment. People listening to this broadcast may have never heard that term before. I cover that in another broadcast. But the point is, if you've never heard the term before, here's what it means. In order for you to make money, somebody else has to lose money. So if you're losing money consistently, that money is going to a trader who is on the right side of that trade. That's where the money goes. It doesn't go to the market or into some nebulous computer something somewhere. Your money is paid from the clearing firm deducts the cash from your account and gives it to the winning trader on the other side, right? How are you going to reduce that risk? You can't reduce that risk. The risk is you could be on the wrong side of the order flow at any point in time, and if you're on the wrong side of the order flow, you lose. That's it. That's the only risk in trading. You can't reduce that by study, because study is based on price. And the assumption of study based on price is that all this combination and dividing of prices is going to predict where the market's going to go next. But the only way the market can get to that price is if enough orders come in on that side. So if enough orders don't come in on that side, all your prediction is meaningless. That's the assumption. Certain things are facts, right? What's the fact? The market held support, therefore it's going to rally. And 2 days later, it's 150 lower, and you can't figure out why. So what do? In order to reduce the risk, you go back and study more. But that's within the illusion that market study is the key to understanding how the market's going to move. See, misconceptions and illusions, if these are present in a trader's thinking, they affect the conclusion-making process about the meaning of particular prices or price action. The prices don't have any meaning. The prices don't mean anything. What matters is who's buying, who's selling, and who's going to lose. So misconceptions and illusions, they're manifested in a trader's thinking by the use of certain words during the assumptive process of evaluating a market price potential. And you know, if you're honest, you have done this. These are should, and must, can't. For example, if a market moves to a particular price level, that is what should happen, and therefore the analysis done to create that knowledge is validated. So the illusion is more firmly believed. That's what should happen. So it should pull back, and then I can buy it at the next support level, which it should hold. It can't go any lower because it's already made X number of lows. Do you understand what I'm saying? So this process is based on previous price action. So the illusion is basically an assumption the past will create the future based on some form of predictive analysis. So if a market reaches a certain price area, the trader opens a position because the price should now move to the next area predicted by his analysis. So if the market moves to that area, creating a profit, that is what should happen. And now, therefore, this analysis method is confirmed in the mind of the trader as having enough value to use it the same way again. So now if it creates a loss, you're confused. Well, it worked before, but it didn't work this way. Maybe I don't know enough about using MACD, for example. Maybe I don't know enough about how prices use Elliott wave, right? See, illusions can take many forms, and the most common is the general acceptance that some things have more or less meaning based on how well the trader understands something. For example, losing traders tend to believe that a particular piece of fundamental information is more important than another because they understand that particular fundamental in question. Like I've met people that are experts on the non-farm payrolls report. Non-farm payrolls report comes out, they put a position on, they get their ass kicked in about 20 minutes, and they can't figure out why because the report was bullish and therefore the market should rise. Well, it doesn't matter if the news is bullish or bearish. What matters is that the order flow is changing. If you can't see that order flow change, you lose. So the misconception here, the illusion, is that the news matters. The news does not matter. So if what happens the way it should happen, people tend to believe the illusion more. If it doesn't happen, they tend to believe that they didn't do the study well enough, and therefore they go back to the market charts and information and study it even farther and harder, right? But all of that goes on within the process of justification, because losing traders feel that they have to evaluate and explain their losses. My loss happened because, and it's always something that has nothing to do with why the market is trading the way it's trading. And this is all part of the illusion or belief structure that says prices can be predicted. So if the market, quote, went the wrong way, that loss could have been prevented somehow, which is a feeling of control. But that loss could not have been prevented because you came to the conclusion to buy or sell based on an assumption in the first place. So the assumption that prices could be predicted, and I've done this evaluation through all my study, and now I put the trade on, and now it's a loss. Well, that could have been prevented if I'd done the research better, right? So the critical factor in this thinking is that the focus of the justification is always outside of the trader. The charts were wrong. So-and-so said something that ruined my trade. The news was a surprise, etc. Since the trader is trying to reduce risk, which means gain control, and the loss happened because of something there was no control over, then that explains it. And the blame is not due to the trader. See? Losing traders feel that losses can be avoided and therefore invest huge amounts of energy attempting to explain why losses happen. Losses cannot be avoided. If you're on the wrong side of the order flow, you lose. That's it. There's no way to avoid the loss. But if losers try to take all their market knowledge and explain the loss, justify the loss, this is why it happened, they're doing that because they want to gain control over the trading process to prevent losses in the future. And you can't do that. Some of the greatest traders that have ever been in history have made hundreds and hundreds of millions of dollars. Back when $100 million was a lot of money, with 30 years of experience or more, like myself, still have losing trades. You can't avoid losses. So the attempt to explain or evaluate the loss to justify how it happened is one of the things that losing traders think about and creates their losses. Expectations, this thinking process, this is really dangerous. This is a very difficult position for a trader for the simple reason that once an expectation is held in the mind, it reduces the ability to perceive other information that would confront the expectation. In other words, if you're bullish a market, you're going to do your evaluation and interpretation and prediction in the market from a bullish bias. So you're going to look for the things that support the bullish hypothesis. You're not going to look for things that would say maybe downside potential is more likely at this point, right? Once the expectation is held in the mind, no other data is absorbed. So expectations result in the trader putting confidence in something that he is not completely understanding. A perfect case of this is buying a trading system or buying a robot, an electronic assistant, or some other form of software. So you purchase a new trading system because it's based on the latest and greatest of everything. And it predicts, by backtesting, a significant gain over time. You begin using it, you start having losses. Your expectation was that this system was going to make money. Now it doesn't. See, expectations create bias. So if it doesn't make money, something is wrong. Yeah, what's wrong is your expectation. It's not the system. Every system has winning trades and losing trades. They have winning and losing trades all the time. The expectation is the problem. So if that system is something that needs 6 months of consistent discipline to make gains and you bail on it in 90 days, then you're not getting the benefit of the system. But your expectation was, I'm going to make money right now by using this system. So since your expectation wasn't met with the results that you expected, which is another error, right? What happens? You quit on it. The important issue here is that every trader that expects something to happen does not see why that expectation caused the loss. They then do the next step: exceptions, excuses, or blame. I expected X to happen and Y happened. I didn't expect that. So there has to be a reason why that is. Now we have an exception or an excuse, which is basically a way to transfer blame. This thinking can be summed up in this fashion: whatever happened, that's not my fault. If a loss happened because of an exception or an excuse, then the trader bears no personal responsibility for it. It couldn't have been avoided. See, earlier in one of our other problems, the gain for control, the justification problem is I can figure out why the loss happened. So I can predict prices better. When a loss happens that you can't explain, well, there's no way to avoid that. So we can excuse that, or it's an exception. Well, ordinarily the MACD would predict prices, but this time it didn't because Janet Yellen was talking, so it's her fault, right? This is the end result of illusions operating in the trader's thinking. The trader was, quote, reducing risk according to what the charts say, but something happened that isn't supposed to happen. So there was simply no way to avoid that loss, which is keep control. So the trader doesn't have to accept the blame for himself. Now, how many times have you heard this from losing traders where they did something and the market went against them and they said, oh, that's so-and-so's problem, falls not mine, it was my broker's problem. Look at how I got skidded on that stop. I never would have had a loss if it wasn't for I was skidded 20 points, right? See, this thinking is really the way most losers and most losing traders justify their losses, which is in reality is a question of refusing to accept personal responsibility. See, remember before when I said you have total control over your losses and your gains? You decide when to click the mouse. So if you do something and the market goes against you, it's your fault. You need to get out. You need to cut your loss. It's no one's problem but yours. But if you blame, make excuses, or have exceptions for it this time, that's loser thinking.
See, nowhere is it more true that you are responsible for your actions than in trading. But if a trader can find a reason where this is not so, he will not feel the emotional pressure of, quote, making a mistake. One of the major reasons why people fail or get fired from a job or end up divorced or any number of losing events that they're participating in that can almost always be traced back to this just one issue, an exception or an excuse. Oh, everything's fine, but my wife. I shouldn't have been fired. My stupid boss doesn't respect what I do. There's a blame. Can't you see that? See, this is what will kill you faster in the markets than anything else, is blame. So to summarize this up real quick for you. As you can see, all of these various methods of thinking are interrelated and often involve more than one kind of thinking operating at the same time. In other words, assumptions, expectations, excuses, evaluations, misconceptions, illusions, they may all be present at one time. So your head can't unravel all of that at once. That's where your losses are coming from. The end result is virtually no potential for a trader to make consistent gains because his thinking will most likely lead to placing trades for reasons that have little or nothing to do with the actual price potential. We haven't even touched the surface of what order flow means and why zero-sum transactions are so important and why they're structured differently than most and why you can't have this kind of thinking and expect to win in a zero-sum transaction market. See, the point of this broadcast is to say to you, wait a minute, if you've done any of this thinking, that's where your losses are coming from. How does this come out in your trading? Well, right here. Things like waiting for confirmation. Why would you do that? If the market gave you a signal to buy, why would you wait for confirmation? Because that will prove that the market's moving in one direction. No, that doesn't prove anything. The order flow was going in that direction. You had the opportunity to take it when the time was right. You didn't, which means what? You need a sense of control. You're afraid of losses. You need to evaluate the market before you can participate. You think the price matters, so the higher the price goes, the more certain it is to keep going higher. All of that is an illusion. It's a misconception about what drives pricing. So if you're trading based on those illusions and misconceptions and assumptions, your potential for losses is higher. The probability of you making gains is almost zero. You're going to wait for the news first. Why? Why do you need the news? Because of something else. Okay, so that's an evaluation. I need the news, otherwise I can't trade. Right? What else? They're all attempts to reduce risk, which means what? Gain control. But you can't gain control and you can't reduce risk. These are all based on assumptions, illusions, misconceptions, etc. in the first place. So as you can see, all of these kinds of losing thinking are interrelated. These loser thinking patterns are the root of anyone's inability to succeed at anything they're trying to win at. But in trading, they become more acute due to the fact that you cannot win if they are present, period. While in other pursuits, you might be able to gain some method of success due to whatever is involved with that particular method of success. But in trading, it is a kill or be killed environment. If you are on the wrong side of the order flow, you lose. So if you come to the conclusion that it's time to do a trade and it's not based on an underlying understanding of the order flow, you lose. So if you have an illusion, a misconception, a justification, an excuse, an exception, some sort of blame, whatever it is, if it's all of them working together or just one of them, you're on the wrong side of the order flow, you lose. So you can't have any degree of success in the marketplace if any of these loser thought processes are present in you. You can't reduce the risk. And this is why some people can be very successful at some things and still fail miserably as a trader. For example, I've had students in my psych course that were very successful at what they did. I had one guy was sat on the board of directors for a major airline. He was the chief pilot. He spent 30 years being an airline pilot and was the top guy at a major airline. This dude was making bank. He's not an idiot. Couldn't make any money in the markets. Couldn't figure out why. Well, the reason he couldn't do it is because he brought to the table an entire decision-making process that worked running an airline. Things like, we can't take any risk because if we do, an airplane crashes and everybody dies. So these are the things that have to be done right. Otherwise, we're taking a risk of an airplane crash. So he comes to the markets and he says, I've got to find a way to reduce risk. Otherwise, I'm going to lose. What he didn't know is that you can't reduce risk. So all of his decision-making process was coming from an illusion and an assumption that was causing him to buy and sell in places that the market didn't offer any potential in. But he didn't know that. See, going back to our red letter edition earlier in this broadcast, which you're welcome to review again, why do losers lose? They are either ignorant of the issues that are causing their losses or they're unwilling to make a change, or a little of both. In his case, he was willing to make a change. He just didn't know that that was the problem. But all of these issues come from loser thinking. All of these critical loser thinking processes are the same for anyone that's facing a failure in any area of his or her life, any one of them. Our external reality is what it is for us, largely due to how we structure our internal world, our thinking. To excel at anything, we must change and adapt our thinking to the requirements required for that success. One of the reasons why I believe that trading is an evolutionary process and success at trading will mean more success in every area of your life is due to this issue of confrontation. You simply cannot win consistently unless you confront the things that are common to failure in everything. So by confronting loser thinking in your trading now, you're confronting loser thinking that leads to every other kind of failure anyway in your life. This is why I believe that trading cannot help but make you a better person in the long run. You must become a better quality person to succeed at anything anyway. And the trading environment requires that you evolve as a thinker in order to win consistently. So if you remain unwilling to do that, you lose. The longer you fight the process, you lose. See, a wake-up call is common to everyone who eventually reaches the success they want. I got it. Everyone I talk to gets it sooner or later because you can't get there without it. In the markets, the wake-up call is your losses. Your account balance doesn't lie. And this is why trading is so difficult for most losing traders. They either don't know they must change their thinking to succeed or simply refuse to believe they need to do that. They continue to lose while all the time getting even more market knowledge when in fact the real problem is within them. The reason success in trading continues to be a rare thing for the most part is because success at anything is rare for most people. To become a top performer at anything requires that you make choices differently and change what you're doing and keep working at that change until you master what is required to succeed in that environment. Most people will not do that in the first place with anything they do. That's why most people are average, apathetic, and indifferent on everything. They have average lives, average relationships, average incomes, average kids, average hobbies, average sex, average everything. They're never on the cutting edge of what it really means to have any of those things because they're not pushing the envelope of what's required to be successful at the best level. Well, in trading, you don't have a choice. You're never going to make a fortune doing this until you accept the fact that it's your thinking that's causing the losses. If your thinking, what we've talked about so far today, if your thinking involves any of those issues on any level, evaluations, assumptions, misconceptions, illusions, justifications, expectations, exceptions, excuses, or blame, If any of that happens in your day-to-day trading, you don't have a chance, not a prayer, of making money, not even to begin with. Most traders don't possess the ability to learn what's required to win, either by ignorance or by refusal, and that's why you have a choice right now. You can raise the bar and say, I'm going to stop doing what hurts me and start doing what helps me. Make that shift in your thinking. I'm going to stop doing what hurts me and start doing what helps me. I'm going to stop thinking like a losing trader. I'm going to do whatever I can to begin that thought process differently. At that moment, you have now gotten on the pathway to success. It's the same commitment that someone has to make if they're going to get out of any problem in their life. I'm going to stop doing the stuff that doesn't work, and I'm going to start doing the stuff that does work. Thank you for listening. Please consider me your friend in the business. My other presentations in this series are available anytime. All you got to do is click the link shown on the page. Other products and services are available as well. Just go ahead and visit other areas of my website. The key takeaway from today's broadcast, the key takeaway is simply this. A losing trader thinks a certain way. A winner does not think that way. How can you make that choice to think differently? Are you prepared to make those changes? If the answer is yes, continue with your education process. If I'm earning the right to be a part of your education process, then please consider working with me on my other presentations or the other products that I offer. If what I've shared with you has value and meaning, that's great. Make sure that you don't lose that value and meaning. A losing trader thinks a certain way. A winning trader doesn't think that way. What is that key difference for you personally? So I hope this information has been helpful, and I'm sure you can review it many times, and I hope you will. You're also available. I'm also available if you want to discuss your trading directly. Depends on my schedule, and of course, sometimes there's a fee for that, but I would be more than happy to do what I can for you. And I would encourage you to continue attending my other broadcasts, my other educational services, and to think seriously and critically hard about taking my Psychology of Trading class. Because in that class, that's where we talk in detail about how to solve this problem, how to flip that switch from lose to win. And it's not as hard as you think it is. Stop doing the things that hurt you. Start doing the things that help you. At first, raise that bar on your personal level of performance at thought level. Stop making those assumptions and evaluations. Stop making excuses. Stop putting blame out there. Even if you think you're doing that, but your account balance is dropping, something is not right. The fact that your account balance is not what it could be, and you know it, says the problem is inside your head. Just accept that. Don't be the trader that's unwilling to change when he's confronted with the need to change, because it's not gonna happen for you otherwise. So thanks for attending. Like I said, please consider me your friend in the business. Love to hear from you. Love to have you attend some of my other presentations. And until the next time, good luck, good trading. Thanks for listening.